Good evening. Tonight, we examine a significant development in the United States monetary system that has largely escaped mainstream attention. The American money supply, measured by what economists call M2, has undergone an expansion of historic proportions. Since January 2020, M2 has grown by 42%, representing $6.3 trillion in newly created money over a 4-year period. To understand the magnitude of this figure, we must place it in historical context. This rate of monetary expansion is unprecedented in American peacetime history. The last comparable instance occurred during World War II. Before that, the closest parallel was found in Weimar Germany during the early 1920s. However, the comparison to Weimar requires careful examination, as there are crucial differences we will explore throughout this report. What makes the situation particularly complex is the behavior of what economists term money velocity. This measures how quickly money changes hands in the economy. During the initial phase of this monetary expansion, velocity collapsed. The newly created money did not immediately flow into consumer prices. Instead, it remained largely dormant in bank accounts, money market funds, and various financial assets. One financial professional described the situation as printing a tsunami of money, then damming it up. Now, that dam shows signs of weakening. Recent data from the Federal Reserve Bank of St. Louis reveals that M2 velocity reached 1.47 in the fourth quarter of 2023. This represents a significant increase from 1.10 in the second quarter of 2020. Rising velocity means money is changing hands more rapidly throughout the economy. When this occurs alongside a dramatically expanded money supply, the potential for price increases grows substantially. Current velocity levels have not been this elevated since 2009. This development raises a fundamental economic question. If 42% more money now exists in the system and that money is moving faster, where will it flow? Across various regions, observers are reporting noticeable increases in prices for everyday goods and services. As we continue our analysis, we will examine how this situation differs from historical precedents and what factors may influence its trajectory. Stay with us as we break down the mechanisms at work and the data that economists are monitoring closely. The Weimar Germany comparison, while frequently cited, breaks down upon closer examination. This distinction matters considerably for understanding the current American situation. Weimar Germany did not simply print money in isolation. The German government printed currency specifically to cover reparations payments following World War I. This occurred while the nation's productive capacity had been severely damaged, and key industrial zones remained under occupation. The United States faces a fundamentally different set of circumstances in 3 critical areas. First, the American dollar functions as the global reserve currency, a status Weimar Germany's currency never held. Second, the United States maintains massive productive capacity across multiple sectors of its economy. Third, American debt is denominated in a currency the country itself controls. These factors do not eliminate risk, but they fundamentally alter the framework through which the situation must be analyzed. Understanding what has occurred requires examining a key decision made by the Federal Reserve nearly 2 decades ago. In 2006, the Fed stopped publishing M2 growth targets. The official explanation stated that M2 no longer maintained a reliable relationship with inflation. However, this decision had a practical effect. Once a metric is no longer officially measured and published, it can be expanded without the same level of public accountability. From 2006 through 2019, M2 grew at an annual rate between 2 and 6%. This expansion was stable, predictable, and unremarkable. Then March 2020 arrived. That month, M2 grew 24.4% on a year-over-year basis, according to data from the Federal Reserve Economic Data System known as FRED. This was not a standard policy adjustment. This represented a fundamental shift in monetary operations. The collapse in velocity during this period provided temporary insulation from immediate price effects. Consumer spending decreased sharply. Businesses accumulated cash reserves. Banks parked excess reserves at the Federal Reserve itself. The money existed within the system, but it was not circulating through the broader economy at normal rates. An economist at the Bank for International Settlements offered a sobering assessment of this dynamic, stating that policymakers had bought time, not solutions. Bank reserves held at the Federal Reserve reached a peak of $4.2 trillion in December 2021. By January 2025, these reserves had declined to $3.4 trillion, according to Federal Reserve data. This represents $800 billion that has left the reserve system. That money has moved into the economy, into lending operations, and into consumer spending. This is velocity increasing in real time, and current data suggests this trend is continuing. We now turn to examining the options available to policymakers and the challenges each option presents. The Federal Reserve faces 3 primary policy options as this situation unfolds. None of these options come without significant drawbacks or risks. The first option involves maintaining elevated interest rates. This approach slows velocity by making borrowing more expensive and encouraging savings over spending. However, high rates create stress in various sectors of the economy. Commercial real estate, companies with weak balance sheets, and regional banking institutions all face pressure under this scenario. Early signs of this stress became visible in March 2023. The second option is to reduce interest rates. Lower rates prevent the breakage that high rates can cause, but they simultaneously accelerate velocity. More money moving faster through the economy creates the conditions for an inflation scenario. The third option is quantitative tightening, which involves actively shrinking the money supply by pulling back the $6 trillion that was added. This process is currently underway. The Federal Reserve's balance sheet has decreased from $9 trillion to $7.7 trillion, according to Federal Reserve data. This represents $1.3 trillion reduced over 18 months. At the current pace, normalizing the balance sheet would require another decade. Economists question whether that much time is available. Some economists argue that the M2 expansion may not produce the effects that traditional analysis would suggest. They point to Japan as a case study. Since 2013, Japan has expanded its base money supply by 400%. The country has not experienced hyperinflation or currency collapse. Instead, Japan has faced prolonged stagnation. The critical difference is that Japanese money never achieved velocity. It remained trapped within the financial system. Banks did not increase lending significantly. Consumers did not increase spending substantially. Deflation became the dominant force. Whether a similar outcome could occur in America remains an open question. However, conditions differ in important ways. United States consumer debt currently stands at all-time highs. Federal Reserve Bank of New York data shows total household debt at $17.5 trillion. This debt requires regular servicing. When interest rates rise, debt service costs increase accordingly. This forces spending to continue even when consumers might prefer to save. In Japan, households maintained high savings rates. In America, households carry high debt loads. These represent different cultural and economic structures that may produce different outcomes. Current credit card debt has crossed $1.3 trillion, according to the Federal Reserve Bank of New York's fourth quarter 2024 report. This marks a record high. Delinquency rates are rising alongside this debt increase. The 60-day delinquency rate now stands at 3.1%, up from 2.1% in 2022. When consumers cannot meet credit card obligations, they typically reduce spending. This slows velocity. However, a trap exists within this dynamic. If velocity slows too dramatically, the Federal Reserve will likely cut interest rates to stimulate economic activity. Lower rates make debt cheaper to service, which encourages more borrowing. Increased borrowing leads to increased spending, which raises velocity once again. The monetary expansion did not occur in isolation from fiscal policy. We examine those connections next. The monetary expansion occurred alongside the largest peacetime fiscal deficits in American history. The federal deficit reached $3.1 trillion in 2020. In 2021, the deficit was $2.8 trillion. By 2023, it remained elevated at $1.7 trillion. Congressional Budget Office data shows these 3 years produced $7.6 trillion in combined deficits. When combined with the $6.3 trillion M2 expansion, the total monetary and fiscal stimulus reaches $13.9 trillion over 4 years. For context, United States gross domestic product in 2020 stood at $21 trillion. The stimulus represented 66% of 1 year's entire economic output. This expansion affected different parts of the economy at different times. Asset prices inflated first. Stock markets reached record levels in 2021. Real estate values surged. Cryptocurrency prices rose dramatically. Newly created money flowed into assets before reaching consumer goods markets. Wealth concentration increased rapidly during this period. Consumer price inflation followed with a delay. The Consumer Price Index averaged 4.7% in 2021. In 2022, it peaked at 9.1%. By 2023, it averaged 4.1%, according to Bureau of Labor Statistics data. Official inflation measurements have limitations. They do not fully capture product shrinkflation, quality degradation, or substitution effects. Alternative calculations suggest real inflation runs higher than official figures indicate. Consumers experience this gap when purchasing groceries, fuel, and housing. The statistical measures confirm what households observe in their daily expenses. Economists monitoring this situation are watching several key signals. Treasury auction demand provides the first indicator. Each week, the United States government sells new debt instruments. Strong demand keeps yields low. Weakening demand causes yields to spike. Foreign buyers are currently pulling back. China's treasury holdings stand at $816 billion, down from $1.3 trillion in 2013, according to United States Treasury data. Japan's holdings remain at $1.15 trillion, relatively stable. However, Japan faces its own debt challenges and may not be able to sustain purchases indefinitely. When foreign demand drops, domestic buyers must increase purchases, or the Federal Reserve must intervene. Federal Reserve intervention represents additional money creation. The reverse repurchase facility provides a second indicator. This Federal Reserve program allows money market funds to park cash overnight. It peaked at $2.5 trillion in December 2022. As of January 2025, it holds $340 billion, according to Federal Reserve Bank of New York data. $2.2 trillion has left this facility and entered the broader financial system. This represents velocity in action. When the reverse repo facility reaches zero, no cushion remains. All liquidity becomes active in the economy. Credit spreads offer a third signal. These measure the difference between corporate bond yields and treasury yields. Investment grade spreads currently sit at approximately 90 basis points, according to Fed data. This indicates market calm. However, high yield spreads are widening, now at 330 basis points, up from 280 in mid-2024. This shows stress appearing in credits with weaker fundamentals. The dollar index measures the currency against a basket of other global currencies. Currently at 107, it remains strong but below the 2022 peak of 114. A break below 100 would signal a regime change, indicating weakening global confidence in dollar-denominated assets. Wage growth provides another key data point. Average hourly earnings are up 4.3% year over year, according to Bureau of Labor Statistics data from January 2025. This is down from 5.9% in 2022, but remains above levels the Federal Reserve considers comfortable for sustained price stability. Federal interest expense presents a particularly concerning trend. In fiscal year 2024, the United States paid $892 billion in interest on the national debt, according to Treasury data. This exceeds defense spending and Medicaid spending. It now ranks as the second largest budget item after Social Security. In 2020, interest expense stood at $345 billion. This represents a 158% increase in 4 years, driven by both debt growth from $23 trillion to $34 trillion, and interest rate increases from near zero to 4.5%. The average interest rate on federal debt currently sits at 3.1%. If rates remain at 5% and all debt eventually refinances at that rate, annual interest expense would reach $1.7 trillion, consuming 25% of federal revenue. Several developments in the coming months will clarify which economic scenario is unfolding. The February employment report will indicate whether job losses are accelerating. The March Treasury refunding announcement will show whether borrowing needs are increasing. The first quarter GDP report will reveal whether economic growth has turned negative. These data points will provide critical information about the path ahead. This has been an examination of the monetary expansion that has occurred since 2020, the historical context surrounding it, and the indicators economists are monitoring. This is educational information and does not constitute financial advice. Viewers should consult qualified professionals before making financial decisions. Good night.